Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is March 3 and welcome the spring finally. This is a weekly markets update. Let's have a look at the news of week 9 and see what are the next trends. Please check out my interview with Damien Heath, CEO of WENF Australia and also Director Fertilizers Australia Industry Association, that was published last week. Damien shared excellent insights regarding Australian agriculture and fertilizers markets, related expectations in front of 2025, so don't miss the jazz. Let's move to the situation in the fertilizers market. Urea market was softening as Indian tender was delayed for one more week. Indian strategy seems to be simple: keep the suspense as long as possible, increase nervousness in the market, then come out with a tender with long ship window that will help to avoid significant competition for tons from other buyers, and purchase at lower price level that potentially it would be if the tender was already in place last week, for example. However, it might not happen as planned due to the other moving parts of the market, specifically US, that will be a major buying destination in March. Prices in NOLA slipped last week to the level of $385 per short ton on the low end due to hiccup in river logistics because of the low river level. Inland buyers were not able to take upriver arriving tons, so they pushed new arrivals to later. Thus, there will be a delay in arrivals to the US market, which is already in deficit. From the other hand, new evaluations of corn acreage published last week showed about 3 million more acres planned versus a year ago, meaning about 250,000 tons of additional urea that will be needed. In order to bring all these massive imports in the US, we'll inevitably need to push arrival time into late April and even first half May, perhaps. Thus, US purchasing will coincide with Indian tender, if the tender is out in upcoming week or two, of course, which is the base scenario now. So again, global price level might be supported by these factors and not drop before April at least. In the Northern Africa, there were no fresh sales last week. European imports demand was slim last week due to price volatility. Domestic distribution demand is rather strong across the markets. And the next wave of refill purchases is expected in upcoming weeks. That will spur imports as well. More product will be needed for Italy and Spain that feel quite tight at the moment. Demand in Turkey is subdued for several weeks in a row, as current international price level is too high for domestic buyers. In the Black Sea, the supply is almost non-existing, so there were no fresh sales last week. On top of that, unusual snowstorm was raging in Georgia, limiting import activity. Middle East was quiet with no new sales. One more big question mark in terms of March and April market direction is Iran and timing of its production restart. Last week, the weather started to improve, and household gas consumption volume steadily decreases. So, the expectation is that Iranian fertilizers producers will gradually come back on stream in upcoming 2 weeks, meaning that massive imports will restart as of end March. This will be the major price downside factor for April. Last week, Pardees sold 30,000 tons cargoes for end March loading at $385 FOB. In Southeast Asia, sales tender of pupuk Indonesia was scrapped as producer received offers in $410 FOB level while targeting $20 more. Brazilian market activity was very slim, but prices slipped over the course of the week by $20, if not more, to the level as low as $420 CFR. But as already said, actual sales were very low. Paper values moved in different directions for different benchmarks. Egypt FOB future for March remained unchanged and slightly moved upwards for April to the average of $400. NOLA values dropped by $25 for both March and April. Arab Gulf FOB, after significant decrease last week, climbed by $15 for March to the average of $415 and remained largely unchanged for April. Brazil CFR remained the same for March, but for April corrected downwards dropped to the average of $388. Ammonium sulfate market situation was stable with not many news. Price at FOB China remained unchanged in the range of $148 to $51. Two tenders were closed in China for standard product, one for 10 to 15,000 tons from TCC at $147 to $50 FOB, equivalent for shipment before end March. And second, from Fibrant for loading during second half of April at price $2–3 lower versus TCC1. The US market is active in terms of imports, so many European producers like Fibrant and Invalior and Lanxess are exporting large vessels there. Also, prices are higher in the US, so the margins are better. However, distribution demand is still slow due to cold weather. In Europe, supply is very tight, so prices are firm and expected to go up more. The level last week was the same versus a week ago for both standard and granular product. In Turkey, currently buyers are reluctant to purchase at high prices. There are cargoes coming, but at earlier conducted deals. Brazilian demand due to off-season is still almost muted. Activity in nitrates segment was slow last week, which from the one hand is surprising because it is just the middle of hot season. However, from the other hand, it is understandable as there has been pushback in the region against the frequent and extensive price increases we saw in the past 2 weeks and months. In Poland and in the European Baltics, distributors are offering discounts to buyers in the hope of stimulating sales. As a result, nitrates have become less competitive versus urea, and the price gap continues to widen. So, it might lead to the scenario when refill purchases that are expected in upcoming several weeks will happen, mostly with urea. Yara in the UK has withdrawn the February and March offers, as it is sold out. It only has tons for April now. At the same time, price for Russian ammonium nitrate from Baltics slipped to the level around $230 FOB. UAN prices in Europe climbed amid general bullish sentiment in nitrates market. It is a catch-up, actually. But further increase will not happen most likely, despite tight supply, as buyers push back. In the US, prices mostly remain stable. Application season is not there yet, but southern farmers are already anticipating it starting soon. In ammonia market, the main news was March contract price settlement between Yara and Mosaic in Tampa at $460 CFR, which is $40 lower versus last month. Tampa price decreases during 3 months in a row, demonstrating general market sentiment very clearly. European delivered prices also dropped to 6 months low at $540 to $60 CFR duty paid level. And there is no firm purchasing activity. In the Middle East, producers continue building length on the background of very sluggish Asian demand. Last week, FOB Middle East price dropped to $305 to $35. Indian demand is slow due to maintenances that Indian producers are going through during February-April. A tender of FACT was closed on Friday for 8 to 15,000 tons, but no details available yet. So, seems like ammonia prices have not touched the bottom yet. In phosphates, market is waiting details of the potential deal between OCP and Indian buyers, and it is still unclear. Some sources say the deal is done and only formalities remain to be resolved. The rumors say that in terms of volumes, deal will include 1.2 million tons of DAP and 600,000 to 800,000 tons of TSP. At the same time, other sources say the deal is not concluded and discussions are still ongoing. Meanwhile, last week, Indian importer is understood to have purchased 45 to 50,000 tons vessel of Australian DAP for the first half March loading. Rumors from China indicate that exports will restart in April, with price indications heard at $630 to $40 FOB. Those levels are similar to previous offers to Ethiopia. Brazilian market has seen some activity and price movement for MAP for the first time in almost half a year. Last week, several Russian MAP cargoes concluded for March loading. Various origins cargoes concluded at $635 to $41 CFR. Phosphates demand is robust beyond just DAP. SSP price corrected upwards to $235 CFR. Also demand for NP and TSP is vivid. Everything for short-term application. US market also was vivid last week after extreme cold weather had dampened demand previously. DAP barges traded at $596 to $610 per short ton for first half of March. Prices increased last week due to active buying, as corn season will start very soon in the south. In Europe, cold weather in the vast majority of countries kept purchasing activity low. Moving to the fundamentals. European natural gas futures fell below 45 euros per megawatt hour, driven by mild weather and potential easing of EU storage mandates. Meanwhile, concerns grew that a potential US-EU trade dispute could raise LNG costs, especially as the US is Europe's main supplier. President Trump threatened 25% tariffs on EU imports starting April 2. However, this decision is not taken yet, as I understand. US natural gas futures dropped after a significant upward rally, driven by record production levels and forecasts for milder weather. The price drop occurred even as strong LNG exports continued. Despite the decline, extreme cold earlier in the year led to significant withdrawals from storage, leaving inventories 12% below the 5-year average. Agricultural commodities future prices showed mixed results. Wheat futures extended their decline to below $5.5 per bushel, as the USDA's Outlook Forum projected increased US plantings and supplies. The agency expects farmers to plant 47 million acres of wheat in 2025, which is 2% more versus a year ago. Prices were further pressured by concerns over proposed US tariffs and potential retaliation against agricultural exports, along with easing weather worries for Northern Hemisphere. Snow cover continues to shield winter crops in the US, Russia, and Ukraine, limiting cold weather threats. Corn futures also decreased lower than $4.9 per bushel, as growing global supply weighed on prices. In the US, farmers are expected to expand corn acreage by more than 4% this spring, boosting planted area to nearly 94.6 million acres, driven by favorable weather, low hay prices that are shifting production from silage to grain, and a reallocation from soybeans, wheat, and sorghum. This increase in supply was enough to offset strong export demand and record ethanol production. Soybean futures dropped more than 3% to $10.12 per bushel last week. Improved weather in South America that is allowing for rapid harvest in both Brazil and Argentina is putting more inventory into the global market. Argentina crop conditions continued to improve for a second week, with 67% of their soybeans rated excellent to fair. On January 27, to support farmers affected by adverse weather, Argentina's government lowered the export tax on soybeans to 26%. From the previous rate of 33%. This makes Argentina's soybeans more competitive in the global marketplace, especially when combined with the higher US dollar. And all this comes at a time when the US government is placing additional tariffs on the America's top trade partners, causing uncertain demand outlooks. Moving to the shipping industry. Containerized freight index dropped more by 5%. Price decrease happened for all key destinations, but especially sharp it was for destinations from China to US ports. However, more interesting is news regarding proposed by US unconventional penalties on Chinese carriers and on non-Chinese operators of China-built container ships, announced on February 21st. The estimated impact of the 3 new tariff fees, if implemented, would be huge. First, tariff on Chinese maritime operators with penalties of up to $1 million per US vessel call would affect COSCO and OOCL. Both are in top 9 operators on US container routes. Second, proposed tariff fees on maritime transport operators with Chinese-built ships of up to $1.5 million per US port call would affect directly or indirectly all of the top 9 global ocean carriers and all the alliances. Depending on the methodology, between 29 to 31% of container ships operating globally are made in China. Almost all companies operate China-built ships calling at US ports. Third, proposed tariff on maritime operators with ships on order from China of up to $1 million would hit 8 of the top 9 alliance carriers. Therefore, top industry analysts believe that more than 80% of current container ships calling at US ports would be hit. In dollars for a typical size of container ship on each of the 3 main US trade routes, the estimated US tariff fee per TEU, 20-foot equivalent unit, would cost between $222 and $500 per TEU of ship capacity. For comparison, these costs would be between 7 to 16 times Europe's new emission trading scheme carbon taxes. There could be Chinese countermeasures, of course, but in any case, it will increase the cost of container shipping. The Baltic Exchange Dry Index again increased, mostly driven by activity in Capesize segment. Capesize markets saw a strong upward trajectory across both basins, with activity remaining strong into the weekend. In Panamax segment, rates in the Atlantic came under severe pressure, while Asia initially appeared to resist the negative sentiment. However, activity also decreased closer to the end of the week. In ultra-supramax segment, as the week progressed, it became apparent that recent upturn in sector had come to a halt. All regions lacked the new impetus. In handysize segment, market showed mixed performance with modest movements across both basins. But in general, very solid activity in Capesize drives the whole shipping activity across the globe. To sum up, further postponement of Indian tender weighs on global market prices. Key suppliers from Northern Africa and Middle East maintained previous or slightly lower level for now, but on the background of muted actual sales activity. The largest newsmaker of the week was USA market, where prices significantly corrected downwards, but most of market players agree that this move will be short-lasting, as fundamentals seem even stronger after new very bullish corn acreage evaluation issued last week. Nitrates prices seem to reach their ceiling, where buyers start pushing back. Sulfate market was largely stable with no major movements. Phosphates price level also remained unchanged, with market closely monitoring situation with potential OCP deal with Indian buyers that seems to be close to finalization. Ammonia price corrected further downwards, with Tampa March contract price agreed last week at the level $40 lower versus February. European gas price was hovering on the level below 45 euros per megawatt hour. However, concerns grow that LNG from USA might become more expensive due to potential tariff war. Gas price in the US retreated from the previous week highs amid warmer weather and steady production. Agricultural commodities future prices all moved downwards due to expectations of ample harvests from key producing regions. Container shipping costs dropped more last week, while sentiment in bulk shipping continued improving, mostly due to very active fixtures in Capesize segment. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.